one of the things we haven't touched on with IUL is the way that we make sure our policies are actually going to run and work and be good, right? So they talk about the war of illustrations, but I would suggest that we need to take that a step further and make it a war of stress testing the illustrations, right? So one of the things that we do, and we hope that everybody does, is that they stress test the policies to see how they run in various situations. Blake, I promise we're going to get to our conversation on whole life in a second, but Rod, run us through stress testing, why it's important, and then we're going to flip the script and start attacking whole life.
Yeah, I would say stress testing is important in any context, whether you're using premium financing or not, but then especially in premium financing. And the reason for that is stress testing is important.
Okay, wait. What is stress testing?
Yeah, so what we're doing is we're saying over certain periods of time, how would it have performed based on the parameters, the structure that we've set up for it, and not just cherry picking and saying, oh, well, if it was between 1992 and 1999, then it's like picking the best
rolling.
time.
Yeah,
obviously it would do great in that time. We don't need to run that stress test because there's no stress in that situation. But what if it is from 2000 to 2009, for example, right? Where the market was struggling for a long period of time, or the Great Depression would have been an even worse market performance time frame. So we use that as kind of one of our big stress tests. So because as it relates to the costs that exist in the IUL and their relationship to the growth that we're assuming is created, which again, in an illustration, just assumes every year we're getting that 5.5% or whatever. So, but what about years where that doesn't happen? It's sold as something where your value never goes down. I hear people say that, and it's poor wording because you don't participate in the losses of the market. You have a 0% floor, but that doesn't mean your value didn't go down. You still had costs in that year. And so your cash value actually does go down in that year, but not because you participated in losses of the market, but just because of the costs that exist on the policy, and you didn't earn any interest to offset that in that year. So we have to know what it looks like in those types of situations. So that's the biggest reason for stress testing. And then when you take it to the premium financing level, which is where we're using loans from a bank for the majority of the money going into the policy to build this large future income and or future death benefit. And when we do that, because now we have a loan out there, we need to create growth in our policies to offset interest that we're accruing on the loan. So now this is additional level of stress testing, because now it doesn't have to just perform against the costs that are internally built into the policy itself. Now it has to perform against increasing interest on the loan that happens every year, regardless of whether the market went up or not. So an additional layer of kind of drag in that situation. So now the stress testing of market performance is important, and stress testing against interest rates. In a high interest rate environment, how does it perform? You have to know that.